What's the story of Retire Young, Retire Rich? In Rich Dad's Retire Young, Retire Rich, 2012, Robert Kiyosaki shares his unique take on personal finance, guiding readers on a journey toward financial success. His key message revolves around mastering the art of leveraging your mind, strategic planning, and decisive actions. Kiyosaki contends that the path to wealth is paved with understanding how to cultivate simple habits and using debt wisely to acquire income-generating assets. Who's the author of Retire Young, Retire Rich? Robert T. Kiyosaki, the mind behind the Rich Dad franchise, is more than an author, he's an investor and entrepreneur. Kiyosaki's journey started with studies in New York, followed by service as a Marine gunship pilot during the Vietnam War. In 1977, he initiated his entrepreneurial career by founding a company selling Velcro surfer wallets. Taking his insights further, he established an international education company in 1985, aimed at teaching the principles of investing to students worldwide. What sets Kiyosaki apart is his ability to sell his business empire and retire at the remarkably young age of 47 in 1994. Who's Retire Young, Retire Rich? Summary 4. Anyone fascinated by the dynamics of money and investments. And for those wishing to learn how to maximize their power to their greatest benefit. Why read Retire Young, Retire Rich? Summary. Ever wondered why getting rich seems elusive despite the universal desire for financial success? Robert T. Kiyosaki, the messenger behind the Rich Dad character, has been proclaiming for over 2 decades that anyone can achieve wealth. The catch? Many are ensnared in thinking patterns that hinder their money-making potential. While entrepreneurs see opportunities, some perceive risks. Where the wealthy recognize tools, others see obstacles. It boils down to mindset, a key ingredient for success. In these insights, we delve into the wealth-building concepts that enriched Kiyosaki himself. By embracing these ideas, you might uncover a pathway to your financial aspirations. Get ready to understand the mindset shift. Discover why success hinges on your mindset and how altering your perspective can open doors to financial abundance. Embracing risk. Uncover the wisdom behind the saying, "Kiss a lot of frogs before finding a handsome prince," and learn how taking calculated risks can be your ticket to prosperity. Income generation. Explore the art of generating income without digging into your own pockets, a skill that can revolutionize your financial journey. The hidden value of problematic investments. Unveiled a surprising truth about why a seemingly troublesome property might just turn out to be your most lucrative investment. Retire Young, Retire Rich lessons. Keycap 1. Learn to use the power of leverage. Ever wondered how to turn a little into a lot? Robert Kiyosaki pondered this question in the 1970s, and 2 decades later, he was on his way to early retirement as a millionaire. The secret to his success? Leverage, the art of achieving more with less. Picture a lever, a simple tool utilizing a beam and pivot to move heavy objects with minimal force. But leverage isn't confined to lifting, it's a universal principle governing the world. In a nutshell, the key message is, leverage is power. Consider the animal kingdom. We aren't as swift as cheetahs, as robust as bears, or equipped to fly like birds or swim like fish. Yet, we dominate the earth. That's the leverage of our greatest gift, the mind. Humans innovate, creating tools like levers for heavy lifting or vehicles for swift travel across various terrains. The history of innovation showcases our journey of gaining leverage over the natural world. Millennia ago, sea merchants harnessed wind power using woven flax, propelling boats efficiently. This simple yet powerful innovation led to the prosperity of those who embraced it, building powerful empires. Fast forward to today, the internet serves as a modern-day lever. Entrepreneurs who recognized its potential early on are among the wealthiest individuals. These insights aren't solely about technology, they're about concepts and strategies that provide financial leverage, helping you achieve more with your money. Keycap 2. Understand the risk-reward ratio. How you perceive the world influences your actions. Your reality is shaped within your own mind, giving you a unique perspective. Consider the concept of risk. The perceived risk often determines your engagement in a particular behavior, like investing, which is commonly viewed as risky. Some avoid it altogether, believing it's best not to play with fire to prevent getting burned. Now, Think about crossing the road, it's risky too. But if you fixate on that risk, fear could paralyze you, making navigating city streets impossible. Rich Dad, however, finds a more constructive approach in the risk-reward ratio. In essence, the key message is, the risk-reward ratio helps you put risk into perspective. While statistics show that 9 out of 10 businesses fail, entrepreneurs continue to launch new ventures. It's not just about hubris, each entrepreneur possesses a unique risk perspective. Relying on the risk-reward ratio allows them to understand the risk they are willing to take. Consider a New York-based day trader, a close friend of Kiyosaki. His strategy revolves around this ratio, never risking more than 1/10 of his assets in the market. For instance, if he has $200,000, he allocates $20,000 for trading, a manageable loss in case things go south. Here's the interesting part, with odds of making money on 1 out of every 20 trades, he risks only 1/20th of his trading fund per transaction, which amounts to $1,000. Even if he loses 19 times, a rare scenario, the final successful trade compensates for the losses. Since market moves usually yield double or more on his original $20,000 investment, the reward significantly outweighs the risk. Understanding and applying the risk-reward ratio can be a game-changer in managing and evaluating risks in various aspects of life. Keycap 3: Learn the debt and wealth ratios. Blaming tools is for the poor worker, but using poor tools leads to poor results. This rich dad wisdom stuck with Kiyosaki, highlighting the importance of concepts as tools for the brain. In the quest for financial leverage, understanding your positive debt, available assets, and income is crucial. The key message is, your debt and wealth ratios can help you track your financial health over time. Starting with the debt-to-equity ratio, it assesses the balance between positive debt and available assets. For example, if you have $100,000 in positive debts and $20,000 in equities, your debt-to-equity ratio is 5. While this figure may not scream insights immediately, it serves as a yardstick to measure your financial health. A sudden increase, like going from 5 to 10, signals a potential problem. Your debt may have surged while equity stayed constant, or vice versa. His shift is an alarm, prompting a reassessment of your finances. Enter the wealth ratio, a tool to measure passive and portfolio income against expenses. By dividing your indirect income by total expenses, you can gauge financial flexibility. If, for instance, your income from stocks, shares, or rentals is $800 monthly, covering $4,000 in expenses, your wealth ratio is 0.2. This indicates that your non-job-related income covers 20% of your expenses. This ratio serves as a guide on your path to financial freedom. A ratio of 1 means breaking even, while anything above 1 signifies making money after covering all expenses. As this ratio climbs, you get closer to making bold financial moves, like early retirement or pursuing a fulfilling job that pays less. Keycap 4: Adopt simple and good habits. In the vast sea of books on getting rich, distinguishing effective advice from the rest can be challenging. Rich Dad proposes a more practical approach: skip the complex models and strategies, and focus on adopting simple, good habits. The key message here is, simple, good habits go a long way. Let's explore 2 habits credited by Kiyosaki for transforming fortunes. First is the habit of learning, a fundamental practice in the dynamic information age we live in. Unlike the past, where individuals applied a set number of skills throughout their working lives, today's reality demands continuous learning. Change is constant, rendering yesterday's strategies obsolete. Staying ahead involves remaining curious, whether through reading, attending seminars, or engaging with people from various industries. Learning something new daily positions you to see opportunities before others do. Investing in yourself through knowledge acquisition not only broadens your perspective but also enhances your ability to identify and seize opportunities. As you explore these opportunities, you might find the need to borrow money, leading us to the second habit: rely on a good bookkeeper. Securing loans often hinges on your financial records. Few will trust you with their money if you can't demonstrate effective management of your own. A bookkeeper plays a crucial role in maintaining organized records of your income, expenses, assets, and liabilities. This professional documentation not only boosts your financial credibility but also increases your financial leverage, opening doors to resources like positive debt. Keycap 5. Use debt to buy assets. Debt as a form of leverage for wealth? It might seem counterintuitive, given the common goal of avoiding debt. However, when used wisely, debt can be a powerful tool to increase wealth, depending on whether it's good or bad debt. In essence, the key message is, using debt to buy assets can give you an infinite return. Distinguishing between good and bad debt is crucial. Good debt generates income, while bad debt erodes existing income. In the former, debt works for you, in the latter, you work for it. While many borrow money for liabilities that cost them more, like vacations or cars, debt can also be utilized to acquire assets that generate income. Real estate is a prime example. Kiyosaki's first real estate deal in 1974 illustrates this principle. Broke at the time, Kiyosaki borrowed $16,000 from the bank and used a $2,000 credit card down payment to purchase an $18,000 beachfront condo in Hawaii. Renting out the property covered not only the loan and credit card repayments, but also generated a monthly income of $25, equivalent to $130 today. Here's the essence: Kiyosaki hadn't spent any of his own money, yet he was generating income after covering all expenses, including the loan. In financial terms, this is an infinite return, essentially, free money. The lesson is clear: borrowing wisely allows you to use other people's money to increase your wealth. This often involves investing in income-generating real estate. The next key idea will delve deeper into this topic. Keycap 6. Finding the right asset takes time. Discovering a great real estate deal boils down to training yourself to notice what others overlook. It might sound challenging, but it's akin to finding the best holiday deal, appliance, or pair of sneakers. You need to explore and compare before making a decision. The key message here is, if you want to find the right property, you have to look at a lot of duds. Rich Dad recommends the 100:10:3:1 method for evaluating potential investments. This involves examining 100 properties, making offers on 10, having 3 sellers agree to your offer, and finally, purchasing one property. This method serves a dual purpose. Not only does it teach you about the market dynamics, but it also acts as a safeguard against costly mistakes. Kiyosaki shares a cautionary tale about a lawyer friend who, without using this method, purchased a beachfront condo near San Diego after looking at only 2 units in the same complex. 2 years later, she was losing over $450 monthly due to increased maintenance fees and lower than expected rent. Unable to sell at a profit, she found herself in a financial bind. The moral, according to Rich Dad: you have to kiss a lot of frogs before finding a handsome prince. Many investors skip the crucial step of comparing potential investments, acting on impulse, hot tips, or hearsay. Kiyosaki's friend's unfortunate experience serves as a stark reminder: those who avoid kissing frogs often end up settling for an unhappy investment. Keycap 7. Problems can be opportunities too. Just like every fisherman has a tale of the one that got away, real estate investors have stories of discovering the perfect property that others overlooked. For Robert Kiyosaki and his wife, Kim, it was a small mountain cabin in Pennsylvania during a vacation. The key message here is, problems can be opportunities. While applying the 100:10:3:1 method even during holidays, the Kiyosakis stumbled upon a rundown cabin with 15 acres of land listed at an unusually low $43,000. The catch? The property's well didn't produce enough water for full-time occupancy. Undeterred, they investigated and consulted a well expert. The real issue wasn't insufficient water, but seasonal fluctuations. The solution? Installing 3,000-gallon holding tanks to store surplus water for leaner months. With this knowledge, they offered $24,000, which the owner, struggling to sell for years, accepted. The Kiyosakis spent a mere $5,000 on the tanks after closing the deal. A month post-installation, the cabin, now with a reliable water supply, was swiftly sold for $66,000, a $37,000 profit. This lesson ingrained in the Kiyosakis underscores the notion that with patience and creative thinking, properties with perceived problems can yield substantial returns. Backhand index pointing right. Discover more. An open letter to my future son and daughter, Step 2. An open letter to my future son and daughter, Step 1. An open letter to my future son and daughter, Intro. Retire Young Retire Rich Review. The overarching message in these insights revolves around the power of leverage in achieving financial success. Entrepreneurs employ various forms of leverage, showcasing how it is a crucial factor in their money-making strategies. The risk-reward ratio is highlighted as a cognitive tool, illuminating the genuine risk associated with an investment. Entrepreneurs, like Robert Kiyosaki, leverage this concept to understand and navigate risks effectively. Credit, often viewed negatively, is presented as a tool for wealth creation when used wisely. Kiyosaki's success story emphasizes the transformative potential of debt when spent on income-generating assets, such as real estate. In essence, these key ideas emphasize the importance of leveraging ideas, strategies, and resources to make informed financial decisions and pave the way for financial success. Whether it's understanding risk, utilizing credit, or turning problems into opportunities, the concept of leverage is central to the journey of successful entrepreneurs like Kiyosaki. Retire Young Retire Rich quotes. Robert Kiyosaki quotes, "Many people want these government loans, but very few people qualify for them. The government will even lend you the money to fix up or rehabilitate the project if you qualify. My income is higher because I use the leverage of assets rather than the leverage of my labor. You should analyze 100 properties, make offers on 10 of them, have 3 sellers say yes, and then buy one. The earnings potential in the E and S quadrants is limited. The earnings potential in the B and I quadrants is infinite. It takes shopping and looking at over 100 properties to buy one property. The trouble with selling your labor for money is that there is only so much you can do." Still in a little disbelief, I asked, "At what kind of terms?" "We bought it out of foreclosure from a bank. And that income can be passed on for generations to come. That was the price she thought we could sell it for if we wanted to." The same is true in relationships and in investing. Last year, one of our divisions had to return over $1 billion because they could not find anyone who qualified for it. Most people act on impulse. Hot tips. It excites me to think about turning a slum into safe housing for people with families. So we become rich by becoming partners with the government? There was a sudden burst in their popularity. But I am afraid he is paying a big price. One of the reasons our educational system is slow to change is largely due to the power of the teachers' union. They know the power of a network. An asset that gives him very little cash flow and will appreciate very slowly in value, if it ever does. The retailers want you to shop and browse.